When we went into the break, we had looked into the performance of several stocks here in Uganda. We looked at stocks in Nairobi, but maybe there are still a few things here and there that might need your enlightenment. And if you have any questions for that matter, you can go and visit us on our hashtag, that is financial markets, and leave a comment. Also, you can find us on our Twitter handle and you leave a comment as well, or on our YouTube live stream and leave that comment. But one of the most common questions that people usually have is, first of all, what are the financial markets we're talking about? Why are they different from the other markets that we know about? And this comes to, of course, giving you the brief background of what it is like to be a financial markets trader, to be a financial markets participant. Now, on the common markets, we have commodities like, clothes, we have food, we have oil, we have all these other commodities that we buy using our money on the common market, where we know all that you go to a shop, you purchase something, and then you get it. Now, unlike this market, in the financial markets, we don't look into commodities. And the pricings we are looking at here are pricings of shares. We're looking at buying shares. We're looking at bonds and bills. We are looking at things, or what we call instruments, that are non-tangible. You cannot touch a share. You cannot touch a bond. You cannot touch a derivative. But these are designed in such a way that they can benefit both the people that are investing in them and the people that they are investing into, and these are the borrowers and the lenders. Now, if you look at this market, it's divided into 4 segments. If you would want to break it down a little further, we have the bond market, which is known as the debt market, where we have borrowing and lending, and I will explain that later on. We also have what we call the commodities market. Now, the commodities market is not something very common here in Uganda, which we talk about, but this commodities market is very lucrative when it comes to developed countries like United States, like China, like Japan. The commodities market basically looks at commodities like gold, commodities like precious metal, commodities like copper, commodities like oil, and other commodities such as maybe silver or anything, crude oil, crude diesel. These are what people sometimes call commodities markets, and these markets focus on pricings of those several commodities that are probably expensive, that are precious metal, like for example gold and silver. They also look into some rare other commodities that you won't find in a shop, or you would not find easily on the market. And so these commodities also tell a lot about the economy. For example, gold it can act as a reserve of value. For example, some countries prefer to buy gold instead of having a currency, so that they can strengthen their currency. Because they believe that the prices of gold will be more stable, or they will go up, and maybe the value for their money will also go up. So people tend to invest in some of these commodities, copper, gold, oil, thinking that maybe their value will be much more reserved than the value of their currencies, and this helps them to actually reserve their currency. And you see that some of these currencies, like the United States dollar, have been able to be strong and remain afloat due to some of these commodity prices, where they give they buy these commodities, keep them, and they reserve the value for their currencies. We also have the derivatives market. Derivatives are different products from all the other commodities, and also debt markets, where we have talked about. They are also, like we call them, derivatives. They are derived from the other markets. You find that a certain derivative looks into the stock markets and also looks into the commodity markets. You find another derivative looking into the bond market, and also looking into the stock market. So these are derived from the other markets and kind of give you a sort of a well-shaken mixture of all the other markets, and they are tailored for certain categories of people. We don't have those at the moment here in Uganda, but definitely these are some of the what we call the financial markets. Now, on the other hand, we have the stock markets. That's the fourth financial market we are looking in. Now, the stock markets, like we all know them, are very, very simple to look at, because these look into raising capital for given companies that are listed on several security exchanges, looking like, for example, the USE, Uganda Securities Exchange, that looks into getting the market for these companies, getting to know that there are these companies that have been listed and they need capital. They are issuing these shares where you have individuals buy into shares, and then when they buy these shares, they are able to sell some of them at higher prices and gain on what is called a capital gain, or they're able to keep these shares and gain some value on the shares. And that is also known as the stock market, where we have issuing and selling or buying of stocks. Now, the debt market kind of works like the stock market, but in this debt market, like the word goes, debt, we are looking into debt, borrowing and lending. So you have government, you have corporate bodies coming to the public to get money, to borrow money at a very low interest compared to what they would get, for example, from the bank or money lenders around the world. And so these debt markets focus on, first of all, we look at the two debt markets. We have the government, and we also have the corporate bonds. And also these corporate bonds look into corporate companies or bodies that are looking to raise money. These go through scrutiny of a certain kind also to make sure that they will not default, and then they get listed on the exchange, these bonds. Now, the debt market works in such a way that you have, for example, a bond is a long-term loan to government. So you have money that you're lending to government for a specific period of time, and government promises a return after 6 months. So bonds, for example, Altex East Africa says you can go and buy a Ugandan government bond that lasts maybe 5 years. So along the 5 years, as we move into the 5 years, you see that you have 6 months of receiving interest, or coupons, what they call coupons, at a given coupon rate. So if the coupon rate is at 17% and you lend government 1 million, it means that after 6 months, if that bond maybe lasts 5 years, you're going to be gaining 170,000 from the government as your coupon. So this interest is paid periodically rather than paid as a whole sum. But at the end of maturity of the bond, they give you back the initial deposit which you made to the government. So government uses this money to grow. Government uses this money for its projects, to build roads, to build hospitals, to go into communities and try to make an impact. And then government can raise this money through taxes and pay it back to the people that borrowed. A matter of fact, government has recently been moving away from foreign borrowing. As you know, that foreign borrowing has its enough share of its bad consequences. You've seen, for example, countries like Kenya go into debt distress. We have seen, them exceed almost the thresholds of their percentage GDP to debt ratio and debt to GDP ratio, and you see that creates a lot of problems because foreign borrowing always comes with hefty interests that maybe are not payable by these countries. So you end up seeing countries, borrowing to pay the debt, like we see in many African countries. They're borrowing just to pay back the interests that they are accruing from the debts that are foreign. So government would rather maybe borrow locally and be able to raise enough money to finance its budget As you know, government comes up with a budget every financial year, and these budgets help the government to budget for this money. And when it uses this money wisely, it is able to gain taxes from the public, and then pay back some of these arrears in terms of interests. And that is a treasury bond. It's either a 3-year bond, we can have a 5-year, we can have a 10-year, we can have a 15-year, or a 20-year. Most people ask themselves sometimes, can I get back this money before the maturity? Well, that is not from government a point of view. You can possess a bond and sell that bond to another person, but you cannot get back the money from government before the period matures. If it's a 10-year bond and maybe in the 7th year you feel like, oh, you know what, I need back this money, you go back and issue this bond on the exchange, meaning you publish that we are selling a bond that I bought maybe at 10 billion, and then you see if there are people willing in the public to buy this particular bond, they will be able to bring back this money to you. Yeah, so they can be able to buy the bond, and from that moment you've sold the bond, you no longer gain the other interest we talked about every 6 months. You now have a person who has been able to purchase the bond and gain the interest on the 6 months basis, and that is called transfer of rights. You're transferring the bond rights to this other person who is able to now gain the interest on this particular bond. And so that is one of the ways that many people make the capital markets, the financial markets profitable. But the bonds are long term. We have treasury bills, however, that are short term, and these go for 1 year or maximum. They go for 6 months also, midway, and there are also 3 months treasury bills, meaning you're lending to government, but in very short term. Definitely the interest on these is much lower because of given the period of time you're lending, but the return comes. So meaning if I keep on buying many treasury bills, the return also gets on, goes on increase. The return doesn't increase for a particular bill, but you see all these returns are coming in, and you have a big sum of returns which you can take home. And this auctioning of these bills and the bonds happens every 2 weeks. So at Bank of Uganda, but of course they invite the banks, they invite stockbrokers, they invite the exchange and some other stakeholders who are able to maybe witness this auctioning and be able to purchase some of these instruments. Now, when you do purchase these, the banks can either issue them to their clients who would wish to invest in the markets. They can also issue them to individuals. They can give them to institutions. So they can also give them to, for example, savings group. So if you have a savings group, and maybe a village circle, maybe an investment club, anything that where you're putting together money, you can also go and claim and say, we want to buy a bond, because basically these are ways of reserving value rather than losing value. The currency loses value every time money is in circulation but is not active. If you have money not in circulation, but really if money is stored, money is kept somewhere without doing something useful, you're going to see yourself actually lose a value for that particular currency. Yeah, you're going to see it lose value. So that gives you kind of a rough picture of what it looks like to trade on these particular markets. But you can also follow on several other diversified products. Other countries have moved into very diverse products. There are options. There are several things that you can trade in. But strictly, you must be dealing with licensed people. That's number one. You must be dealing with a body, a firm that is probably a stock brokerage firm that is regulated by the top regulator. Here in Uganda, we have the Capital Markets Authority, who regulates the capital markets in Uganda. You must have, excuse me, a body that is authentic, that of course you think people are interested in what they're doing, and definitely before investing you must have knowledge. Knowledge is everything, and if there's anything I've learned, if you're investing in the stocks, knowledge comes first. You must know exactly what you're doing. You must be able to understand how the markets flow, how you diversify, how you diversify your risk. All these are important for the growth of your money. Now, these are not the only ways that you can be able to trade, but you have things like collective investment schemes that have become very popular recently. Look at, for example, the first quarter of this year, 2022. The Capital Markets Authority published reports that over 1.14 trillion has been saved by Ugandans, was saved actually in the first quarter of 2022 in collective investment schemes. And this was given, of course, the period that we went through during COVID-19. People learned how to save. People learned the importance of putting money aside for future use. But collective investment schemes give you a new look at this saving, because they give you value for your saving. And the earlier you start saving, the better, because then you can be able to publish your results. You can be able to see how your money has grown, And so collective investment schemes are simply, some people call them unit trust funds, are simply pools of certain amounts of money from savers that are invested as a whole, and to have a bigger return on them. And these are usually done by fund managers. These fund managers are able to man the unit trust based on the amount of money they collect from several investors, put together, and that money accumulates into a big amount, and then they can invest and get bigger returns than you investing individually. Let's just take a look. For example, you're 10 people. 10 of you would want to invest in a treasury bond of 10 years at 17% interest. Now, if each of you invested individually, you'd have 170,000 coming into your pockets, each of you. But imagine you put together that money. If you put together that money and invested it in several other assets, you invest some in the treasury bond, you invest some in the equity market, you invest some here and there, this money can bring more returns because it's bigger. That's number one. And secondly, you have a diversification of risk, because like all businesses, there's risk in the financial markets, and to somehow allay the risk, to somehow reduce the risk, we have to diversify it. You have to invest here and there. You have to make sure that your money is not put in one basket. Don't put all your eggs in one basket. And that's how exactly many investors are able to reduce the risk that comes with investing in the financial markets. So unit trust funds have become very popular, with growth of over 47% just in the last quarter, the first quarter of 2022, and we're also going to see the second quarter to see how also they performed. But we see that these have actually impacted how people are saving, because if you're putting money somewhere and without you working a single day, you see those figures going up. That is something very encouraging. And definitely these fund managers, I've had some of them on the show here talk about the unit trust. For example, Zeno Investments. We've had Sanlam, who are also fund managers. We've had the likes of UAP or Mutual. They're also fund managers. We know Britam Assets. We know Gen Afric asset managers. All these are people that have specialized in what we call the unit trust fund. That fund that helps you be able to invest in a diversified manner. And these pull together a pool of money, a pool of funds, and throw it around wisely, and invest it on behalf of the savers, and they bring returns. And I'm telling you, personally, I've been able to invest in one of these unit trusts, and every time I check my phone, I see there's a little bit of money that has come to my account. There's a little bit, even if it is a small percentage sometimes, based on how much you put, but it's still there. You see money gaining value, and that is nothing beats that. The more you see your money gaining value, it means your money is making you more money. That's how rich people, that's how wealthy people are able to become wealthy, by using money to make more money. But keeping money is not enough. First of all, like we said, you have to make money. You have to be able to have a source of income. You have to go to work. You have to go and find something that can bring you some income. But after you've got that income, start putting aside fractions of that money to help you invest. Now, don't put it under a pillow. Don't put it under your box. Put it on a money, maybe in a fund manager's account, like Zeno, like UAP, like Britam Assets, like Genafric Asset Managers, like Sanlam. These people will be able to invest because they are licensed by a body like Capital Markets Authority, and definitely it can't default. So in case of anything, you just run to the Capital Markets Authority. But these people will do your investment for you. They will do the homework for you. You don't have to mind whatsoever. All you have to wait for is your return. And that money, the beauty of the unit trust, can be got back within 2 business days. Within 2 days, you can be able to withdraw that money. It's not like maybe in the equity market where you have to wait and there's a whole process. Within 2 days, you can get back your money if you want to. But these have become very prominent assets when it comes to investment, and I think Ugandans as a whole, we need to wake up to this and start saving for investment, not saving for keeps. That was just a few tips for you on financial markets, and I hope you took them at heart. But the most important thing is that you start your participation early. If you're a young person, you're an older person, you just have to find someone to give you the right advice. And one way you can find that is by staying here on the show. We will be giving you more and more information to come up. Thank you very much for staying with us since the beginning of the show. My name is Anthony. You can catch me every Monday to Friday from 10 to 1 p.m. Thank you for remaining with us. I'll see you next time. Have a good day.